and welcome to the Financial Thought Exchange podcast of the CFA Institute Research Foundation. We are here at the CFA Institute annual conference in Chicago, and I now have with me Marlena Lee. Welcome.
Great to be here, Lana.
So I'll give a brief introduction of you. So Marlena Lee is Dimensional. She's at Dimensional, and she's the global head of investment solutions. There she leads a team dedicated to providing clients thought leadership, analysis, and education on a wide range of investment-related topics. She's also a member of the firm's investment research committee. So really happy to have you here.
So good to be here.
Wonderful. And maybe you should start by just saying a little bit about what you do with Dimensional and maybe a brief overview of the firm for those who are not familiar.
Sure, absolutely. So maybe I'll start with the firm. We were founded in 1981, so we have over 4 decades of experience managing assets for a particular philosophy. I would say the philosophy is the most important thing to understand. And our philosophy is that we think that markets do a really good job of incorporating information. So what does that mean? It means that we don't spend a ton of time or any time trying to figure out what stocks are overvalued or undervalued, but we are considered active. So unlike a traditional active shop that's gonna do more stock picking or market timing, the way in which we're active is very based on academic research. So even though we trust markets, we still think that there's different expected returns across stocks and bonds. So we kind of draw on more research and data to tell us what areas of the market to focus on or overweight relative to a plain vanilla market portfolio. So that's Dimensional. My role at Dimensional, I run a group called Investment Strategies. And that group's really, we sit kind of in the middle of our investments teams and our client-facing or sales teams to try and get the information that our clients need, whether that's information to help them explain to their constituents about what the market is doing, how to think about it through kind of our lens on investing, or how to think about why is a fund performing the way it's performing, or how a fund might be better or different than other things that they currently hold. How does it fit into an overall portfolio? All of those, anything that a client is going to want to really understand, whether it's we have people to speak to them or creating content or platforms of data to really help them dig into the portfolios, all of those things happens in the investment solutions group.
And are those clients mostly private clients or institutional, family offices?
Everything.
Okay.
So yeah, we have lots of different client types. So from financial advisors to institutions to sovereign wealth, pretty much you name the asset pool, and we have some clients that have been met.
Gotcha. So not stock picking, but still active. Is it fair to say that you're driven a lot by factors, investment factors then?
Yeah, I would call it more systematic, systematic active. So yes, there's certain broad level factors. We certainly are drawing a lot from the factor academic research. But in the end, I would say that there's just a lot of different data points for variables that will give you some insights about a company's expected return. And we're trying to draw from how can we extract it or combine those bits of information in order to get a sense for, do we expect a particular company to have higher or lower expected returns? So examples would be a company's size or its market capitalization, its valuation ratio, so in price to book, its profitability, its asset growth characteristics, its momentum, it's all of that are different pieces of information that we'll use in order to figure out, does a portfolio want to invest in a particular kind of stock? So if it's a more of a component, like a value portfolio, we'll use all of that data to say what is a value stock. But then also within what's eligible for a given portfolio, what do we think has higher or lower expected returns? And to use that to focus on those stocks with higher returns in order to report.
And the factors that you mentioned, those are pretty classical. If I think about the pharma French factors, there is still a lot of research coming out on that. But when you look at the academic research, are you looking also for new factors that people are digging up out there? Is that something that you keep kind of trying to be the first to implement those factors in strategies?
I don't know if our goal is ever to be the first.
Okay.
Our goal is to be very confident. So some of our insights are going to be driven by academic research. Some of our, we have like a very extensive internal research team as well. So even if something were to start within the academic research, there's still a lot of work that we need to do in order to understand how a particular premium behaves, how it acts with the other premiums, because there's a lot of interactions, how it turns over, and just other considerations that we'd want to build into a portfolio design if we become comfortable that something we really believe that it's there and can enhance a portfolio. A lot of times what we'll find is, we'll take a look at something that might have been discovered in academic research, and then once we really look at it, either it's already explained by something we do, or doesn't have, we don't think that it'll survive things like transactions costs. So not every single factor out there is something that you want in your portfolio. It does take a deeper analysis in order to evaluate that.
Have you ever implemented a factor and then afterwards discover that, darn, it actually didn't work that well, did it?
No, I think mostly because
part?
we have such a high bar for what we'll even put into the portfolios. So, we'll want to make sure for really just protect against data mine results. That's a really important thing. And there's a lot of different ways that one can be about doing that. I would say the first is just is there a good reason why you should expect it in the data before you weave his book? So something like the value premium is pretty, there's a common sense worry, right? Like if a stock has a higher return, and just think about what the price of a stock is. It's just discounted expected future cash flows. And that discount rate is the expected return. So something with a very low price needs to indicate, could indicate that that stock was discounted more heavily and therefore is a value stock because it has higher expected returns. So thinking through very, I would say, theoretical frameworks and then looking at the data everywhere. So not stopping at US stock data, which is usually where academic studies start. The US has the longest history, has very keen data sets, but then taking that to other countries around the world, do you see the same things? Understanding how quickly something turns over is also very important, because if you see something in a paper simulation, but it requires a lot of turnover, then once you account for trading costs, then you may not actually realize that premium. So thinking through some of those considerations are ways that you can become a lot more confident that what you see in the research is something that you can actually pursue in a live portfolio.
Gotcha. Yeah. Now, you just came from a panel.
I did.
Yes. I hope that went well.
I think
Yes, it did. And it was some data analytics, so it's very much in line with what we're talking about now. Just what would you say you're hoping that the audience took away, the main takeaway from your remarks on that panel?
Yeah, well, one of the things that I repeated a lot was that you really do have to look at more than just one number, right? As you kind of have to peel back the onion. And the example that I gave was, I think a lot of clients, for example, might look at correlation as a way of trying to assess whether something is a good diversifier. And what I say to that is, you might start with correlation, but I think it's also really valuable to understand a whole range of outcomes. So, they're looking at not just one number, but the example I gave was, sometimes I hear from clients, they think that long-term bonds are going to be a good hedge against equity market downturns. And okay, rather than just looking at the correlation of those two return series, if you're really thinking about how it will behave in an equity market downturn, go and look at the historical data of all of those periods where you had market downturns and understand how that particular asset class became, just as one example. I actually think the best way of evaluating whether something is going to be a good diversifier is to actually look at the underlying holdings and see, what kind of stocks does a portfolio hold, and what is the overlap with the other thing that you want to diversify against. To me, that's the best way, but it does require more data and digging than just looking at a high level correlation. It's just one example, but I think that that's true, that like sentiments of understanding the full range of potential outcomes is really important, and looking beyond, say, like an average return or Sharpe ratio or, a standard deviation.
So one example what you're talking about, right, would be you're looking at a country index. Looking under the hood there will be, well, what sectors does it entail, and therefore should I expect it to correlate with sectors elsewhere, perhaps?
Yeah, or another example is, I think that there have been a few academic papers now about just the factor proliferation, where I don't know what number we're up to now, 300, 400, I don't know, something in the hundreds of different factors. But when you really look at what all of those hundreds consist of, a bunch of them are just value factors. Or a bunch of them are, you can summarize those hundreds in a much narrower set. So I think an important thing to think about is, to what extent does something that you might think is new play with the stuff that's already in your portfolio? And that is, it takes more digging into the data. Like I'll give you not quite a factor example, but just a higher level example of previously we were getting a lot of questions about liquid alternatives. And if you think about a liquid alternative, it's still investing in oftentimes the same stocks and bonds that you might fold in your overall, like a global 60-40 portfolio. So in terms of its diversification potential, if it's all the same securities, then I would say if it didn't expand your investable universe, then it didn't really add diversification. There might be other reasons why you want to overweight or underweight certain stocks. I mean, we certainly do in our portfolios, but to me that the question of is it like adding diversification is not the right question. And certainly looking at correlation is not the right way to evaluate it. Instead, you want to evaluate, okay, well, is there a reason that these things should have or change my expected return profile or change my Versa profile? And that just takes a bit more of an evaluation.
It gets to a little bit what we mean by diversification, that people tend to look at, to your point, just general correlations, and instead looking at it a bit closer, you see different kinds of diversification, and you can slice and dice that differently.
Exactly. Like, this is a silly example, but I think is relevant of if you're just looking at correlation, you know what would have a low correlation to my market portfolio? Like one individual stock. I mean, maybe it wouldn't have low, but it wouldn't be perfect. But adding one stock to your globally diversified portfolio doesn't add diversification. If anything, it takes it away. So really understanding like what is in the portfolios and how much overlap there is, or do you have any gaps in a portfolio? Like, I think that's a better way of looking at it, but does require more data.
Now, on the panel, you did emphasize the size factor. So what would you say does that work? Is that a good factor to look at? Is it useful?
We did a question at the end where I'll just summarize where's the size factor. Because I started out with an example where I was showing just different slides on the size premium. And what we see, because I mean, if you look at the size premium in the US over, let's just call it the recent decade, it really hasn't shown up if you're looking at commercial indices, so like Russell 1000 versus 2000, you're not seeing a size premium.
So you mean for the index as a whole, if you compare those indices' performance?
And I would say that there's no one way to evaluate the size premium, especially because within small caps or even within large caps, there's differences in expected returns. I also think here's where this is a good illustration of you need to look outside of the US where if you look outside the US, you do see positive size premiums, even in that period where it's underperformed in the US. I'd say that that's pretty, that's not atypical, where you have differences in premium experience depending on the region, which is why I would say pursuing all of these things globally is an important consideration. But then when it comes to the US, what you see is within small caps, actually globally in markets, there's differences in expected returns. So there are some small caps that really underperform on the rest of the small cap universe. Those are ones that have very high valuation ratios, so small growths, but also low profitability.
Yeah.
So those types of stocks actually underperform the rest of small cap by, if we're looking at the longest data we have, by about 10 percentage points. So that's a big level underperformance. Similarly, we see companies, small cap companies with very high asset growth year on year. They also tend to underperform other small cap stocks. So if you exclude those from a small cap portfolio, and they're in like a Russell 2000, so and they do represent a drag on small cap performance. But if you kick them out of the portfolio, you are seeing much better small cap performance, and especially outside of the US where you actually see positive size premiums. But then in the US, you can make that correction. We're still not pricing a really robust size premium in the US like it was the last decade. And a big part of that is what's been happening more on the large caps. We're not side of the market. So it's not that small caps have done like really poorly, especially relative to their historical average. What's happened is that you have a handful of really large names. Today, I think we're calling them the Mag 7, previously the FANG stocks, that have done really well. And so you kind of you have to pull back. Again, looking at just the difference in returns or premium doesn't tell the full story. Here, what has happened is you have had a few really great performing large cap names. And I would also say I don't think that their level of outsized returns that we've seen over the last 10, 15 years is something that an investor can reasonably expect on a go forward. We've definitely have lots of different ways of putting this data, but if you look at historically top 10 stocks, they perform very well in order to get to the top 10. But then once they're there, if you follow them, they actually underperform the market by a little bit. Not something with a big T stat on it, but kind of aligned with the idea of you really shouldn't chase performance. So that's what I think has been happening across the US market is a lot of the premiums that we see historical, whether it's the value premium or the size premium, the premium itself has been really distorted by the performance of a handful of really outperforming names. But you can't expect that out of the force.
And so would the story about small caps be that they're up and coming, you would think of them as kind of growth companies, so therefore they're attractive as long as they're not already priced as growth companies. As long as that's not already in the price, as you say, like if they have high valuation. Is that kind of a good summary of just...
I think it's a great summary that anytime you see a high valuation, especially like in a release section, because that's just a caveat, but things with high price relative to something, we happen to like using book values, and especially when you pair that with profitability data, then things that have very high prices and very low profitability, just going back to that simple framework of what is a stock's price, it's discounted expected future cash flows. The number we want is the discount rate. Like we would love to just be able to look at which stocks have higher expected returns and invest in those, but we can't do that. But we can see its price. We can get some idea of its profitability. We can certainly see its historical profitability. And it turns out that its current profitability is a pretty good predictor of what's going to be more or less profitable in the future. So if you think about a company with, let's just say it's zero or negative or profits even, and has a very high valuation, how does that work in just a discounted cash flow model? It had to have a very low discount rate applied to it in order to have that map out. And that's what is borne out in the data of those types of stocks have very low returns. And if you look at just the historical trend in those names, it has been the case that those stocks with very low profitability, high valuation, over time they've gotten worse in terms of their valuations. Their profitability has actually been going down over time if you're looking at these segment of stocks, which makes it even more important to take into account some of those data items when constructing a small cap portfolio. I would absolutely if anyone wants to not be in a rigid index approach in any area of the market, I would absolutely say small caps is definitely a place you don't want a rigid index. First, you have all of these small, I call them small prep. You have all of these really underperforming or very low expected return small caps, but then you also have a bunch of, small caps tend to be less liquid. Yeah. So having a rigid approach like an index approach in small caps is really where you would expect to kind of read the most at a table because of more of a naive investment approach in that space.
And then a lot of people would claim too, right, that if a company is up and coming, then there's also a risk of them declining, just like private companies. So you might get high returns, but you're also taking the commensurate risks. So your Sharpe ratio should not be expected to be any higher. What do you make of that argument?
It's funny because when evaluating Sharpe ratios, I actually think it's really important not to evaluate the Sharpe ratio of a particular slice of a portfolio. Because, let's just say small caps, right? If you're just looking at the Sharpe ratio of a small cap portfolio, and small caps tend to be more volatile. So it may have a lower Sharpe ratio, but that doesn't mean it doesn't belong in your portfolio. Let's just say you own only large caps. You still, first there's just diversification benefit, because if you own large caps and you're missing small caps, that's expanding your investment universe. To me, that's the starting point for evaluating diversification. So you definitely want to own caps. I do think that there's a question of whether you want to overweight small caps relative to the market. And there, I think having kind of a more nuanced approach to it, of there are certainly areas of the small cap market that you may want to overweight, and others that you want to underweight. So understanding how you're deciding, that nuance of how to incorporate small caps, that I think is much more important than just looking at Sharpe ratios.
And do you do investments like that on a dynamic basis, so that you're saying, well, this factor has underperformed, and therefore let's have more of that in your portfolio? Is that part of your approach as well?
Yeah, we've done a lot of research to figure out if we can time these factors or these premiums. And it's a really tough thing to do. And part of it is just because let's just say, rather than talking even about size premiums or value premiums, let's just talk about equity premiums, right? If you have a traditional investor who's in a 60-40 portfolio, and I truly believe that the equity premium does vary through time, right? During periods of heightened risk, for example, people may demand a higher reward to own equities. But the challenge is trying to predict that in a really precise way, where going from a 60-40 up to 70-30 or down to a 50-50 there's just not enough precision in any of these predictive models to be able to do that, where it's worth the additional transactions costs or even tax costs associated with it. So even though I believe that there is some variation, I still think a more static or more strategic approach is the right way to go. And the same thing applies to any of these other premiums that we're talking about. I think that just like any price, there's probably some variation in how big of an expected size premium or value premium or any of the premiums. Yeah. But I think it's really hard to add value by trying to time these things. Yeah. And I think that all of these premiums are always positive in expectation. So if we're talking about, I don't know, what is your favorite equity premium number? What do you think it is? Is it 6%, 8%? I mean, who knows? Even though it's backwards, no one really knows exactly what the equity premium is. But let's just say, I knew it was 8% or whatever. if I could tell you it was going to be 9 or it's going to be 7, does that necessarily change how you'd construct a portfolio, or is it more important to know it's causative?
Right.
I think that that's
Maybe somebody would apply a Merton share and do some kind of fancy math around there and some other factors, and yeah.
yeah, but I think the important thing is that there's very good reason to believe that all of those premiums always positive. And therefore, just having a strategic asset allocation is the way we manage the portfolios, and is, I think, an appropriate way for a lot of people to think about how to incorporate portfolios into their overall asset allocations.
So you're emphasizing the strategic. How much, when you're looking then at a client, how do you determine how much of active versus passive any client should have in the spectrum between very passive, right, and some strategic or something maybe even tactical, I don't know, shorter term? Like what's the general approach of determining that with any client that you have?
So we at Dimensional provide like kind of just the components. So we'll have everything from market-wide portfolios from the U.S. to international emerging markets to component portfolios. So if you just want a portfolio with value stocks, or you just want a portfolio with small cap or high profitability. So we're building kind of more the tools in the toolkit, and then our clients can achieve their whatever asset allocation using some combination of the portfolios that we provide. You're kind of going towards, like, the first part of your question is how do we, or I would say more of our clients, think about the mix of like index versus like how much to tilt, I would say, a portfolio, like how much more do you want to overweight small cap or value? And there I really think that the trade-offs are more into like tracking error, expected return space. So any portfolio that's going to more heavily emphasize stocks with higher expected return, they're going to have tracking error to the market, to to a benchmark, and that level of tracking error, like looking different from the market, is first what's needed in order to pursue outperformance relative to a market, but also then means that there's tracking error. So let's just say with an advisor, if I'm walking them through these decisions, I think it's really important for them to understand, here's what the portfolio could look like relative to like an S&P 500 in periods where the premiums are not showing up. And here's kind of the long-term experience so that they have the information to be able to make that trade-off for their business and for their clients, because it really is more of I wouldn't even say, because like if you're looking at the volatility of a lot of the, like if a global tilted portfolio, the volatility isn't really that much higher. So it's not really about a trade-off there between expected return and the volatility. In most cases, the real trade-off is the chance to underperform the market in order to pursue long-term outperformance.
Right. Well, thank you so much. This has been a wealth of knowledge and wisdom. So really appreciate taking your time. Yeah. And thank you for tuning into the Financial Thought Exchange podcast.
For more information, please visit rpc.cfainstitute.org/research-foundation.